Hi, when focusing on those high quality and potentially undervalued stock on Nairobi Security Exchange, first step is to focus on businesses with strong fundamentals. Second, with solid earnings history. Third, consistent dividend payers. And finally, with growth potential. And if you are there and you don't know which are these shares with all these characteristics, I'm still selling my ebook. The link is in my bio. How to pick profitable shares in Nairobi Security Exchange, and it's going for 400 shillings only. So once you identify this first step, then you can do the valuation method. You value, if assume you pick KCB, you can now value KCB to see whether, because KCB, it has all these characteristics. You see whether it is undervalued or overvalued. So how do we calculate valuation? There are many ways to calculate valuation of a share, but let me just explain two. One is what we call asset-based valuation or book value method. This method, it looks at the company net asset. Net asset is the total assets minus total liabilities. And why it matters, it shows the real value of the company assets per share. So from this, and these total liabilities and total assets, I told you get them from the financial statement of a company. All these companies listed in Nairobi Security Exchange, they publish their books. You can get them, the books, in their websites. If you go under investor relations in their website, like now if you go under equity, you go under equity holdings, you get investor relations there. You click there and you'll be able to get all those financial results for dating many years back. So once you are there, for these total assets and total liabilities, you get them under the balance sheet, or what we call the statement of financial position. So you get the net assets of a company, which is total assets minus total liabilities. Then you divide by the number of shares outstanding to get the book value per share. In simple terms, it means if the company closed today and sold all its assets, what would each share be worthy? So assume an example like KCB. They reported their annual reports the other day. From the annual reports, we can see that the net assets of KCB is 331 billion. That is the total assets minus total liabilities, what we call shareholders' equity. So once you get the net assets, divide by the total shares outstanding. So the net assets for KCB is 331 billion, divided by the total shares outstanding, which is 3.213 billion. What do you get? Kenya shillings 103. So each share represents about Kenya shillings 103 of the assets on the company books. Now compare that with the market price. The market price was between 68, 69, 70 there. So what does that mean? The stock is trading below its book value. So in other words, KCB is undervalued. The other method is called the earning value or the profit method. In this one, you take the net profit divided by shares outstanding to get the earning per share, or what we call the EPS. But this one you don't have to calculate, because in most of the books it's put there once they are reading their financial statement. You can be able to get the DPS, which is dividend per share, and earning per share. So for KCB, for last financial year, it was 21.3, because the net profit was 68.4 billion divided by shares outstanding, which is 3.218 billion. The EPS, or the earning per share, is 21.3. Now once you get the earning per share, to calculate the fair price of KCB stock, you multiply that earning per share times the normal price earning ratio for the bank or the industry standard. And as at now, the normal PE ratio For the bank, it's around 4.8 or call it 5. And these figures, like the normal price earning ratio, if you don't know how to do the average price, share price for the banks, and then you divide by the EPS, you can be able to Google it and get it. Currently, it's at 4.8. Call it even 5. So to get the fair price of KCB as at today, earning per share was 21.3 multiplied by 5, which is the normal price earning ratio for the banking industry. It gives you a total of 106.5. Now compare that with the price of KCB, which is 68, 69, 70. Still show that it's undervalued. You see, that's how you do it. If you don't understand the second one because it's a bit complicated, use the first one when you're doing the valuation, because that one is straightforward, getting the net assets, and then you compare with you divide by the number of shares, and then you compare with the price of the stock as at that date, and you'll be able to get valuation method. There are other methods which you can use to get the valuation of a company. You can remember even during the Kenya pipeline time, people are doing the price earning ratio, where they were getting the current share price, which was around 9, and then they were dividing by the earning per share, which was coming to around 0.4 something. And then they were saying that it will take a whole 22 years to recover your investment, which meant that the share was overvalued. Maybe we can do one for DTB using the book value method. If you look at using their latest financial results for the period ending 31st December 2025, their net assets was 113 billion, and then the total shares outstanding is 279.6 million. So to get the book value per share, it's 113 billion divided by 279.6 million. Do you know how much it gives you? Kenya shillings 404 per share. Do you know how much DTB is trading at the moment? Between 146, 147. So it shows that DTB is undervalued. I don't want to bother you with so many jargons, but I prefer this method of using the book value per share. It's much simpler and any beginner can use it. But once you calculate your valuation, remember the first 4 questions that we asked ourselves about profits, growth, dividends, very important before you decide whether to invest on any counter. Thank you.